All right, welcome everyone. Welcome Rain King members, and also a special welcome to those tuning in from the public to hear about this GMU. Every Friday afternoon, we talk about the general markets. So let's get started. All right, the presentation's made by Rain King LLC for educational purposes. All right, we've got a lot to cover today. Got the indices and breadth. Going to talk rotation and participation. Then briefly, we're going to talk about market sentiment. We're going to have a summary. Then I've got a few special important announcements. Okay, let's go over the indices as we usually start with every Friday. This is the S&P 500. It's December 6th, 2024. Now, the S&P this week has kind of been slower. It's not leading right now. The NASDAQ's had a powerful week, and tech stocks have started to reassert themselves, which is a good sign. So we're going to talk about tech in quite a bit of detail in a minute. So we still have net new highs, so that's really, really good on the S&P. Now let's turn to the NASDAQ composite. This is a daily chart of the NASDAQ. The upper pane is just showing the percentage of stocks in the NASDAQ that are above their 50-day moving average. And I've drawn this line at 50%. Typically, we want to see 50% or more in a bull market. Right now, we're currently at 64%, but we're curling down a little bit, but we're still above the 50 level, so that's good. We had a nice accumulation day a couple of days ago in the market. You can see the nice volume spike here, and we're at all-time highs now in the NASDAQ. So the NASDAQ has played catch up, and it looks like it's trying to reassert itself as a leading index. We've had some nice consistency in the new highs this week. You can see here we've had consistently new highs for the past week in the NASDAQ. So again, that's really, really strong action. Definitely constructive. Now let's look at a little bit of some rotations. When we look at the indexes a little bit closer, and I'm looking at four indices here. We've got IWM, which is small caps, MDY, mid caps, the S&P 500, and I got the Qs. And you can see here that the Qs have been the strongest in the past 2 weeks. Really a nice surge up to new highs. That's large cap tech. Large cap tech is starting to lead again. The S&P is going up, but it's not as pronounced. There's a lot of QQ names in the S&P, so that's helping to move this up. But you can notice that the mid caps and the small caps in the past 2 weeks are taking a break after they had a very torrid uptrend after the election. So it's interesting to see this dynamic because it's pretty pronounced what's been going on the last 2 weeks. Now, another look at breadth, again, looking at these indices is looking at, we've got the Qs, which we just talked about. The Qs have been the strongest. There's the S&P. But if you look at the equal weights of both of these, this is the S&P equal weight, and this is the equal weight of the QQQ, you actually see it's turning down. The equal weights have been noticeably softer than the indexes I mentioned. These are dominated by the Mag 7, the Qs, and a lot of the tech sector is still in the S&P 500. So under the surface, it's not as strong. And I just put out a tweet this morning here that generally this week, every day, the advanced decline numbers have been weaker under the surface, and the up-down volume has been weaker under the surface in the S&P in particular. Now, the true leading stocks are definitely marching ahead to new highs, very strong. They're getting extended, but it's important not to get sloppy and putting on trades in lagging stocks just because you want to increase your exposure. Because if we get a pullback, you're probably going to get caught overextended. So it's interesting to note that the rotation that's going on in the market, we have to see how serious this develops going forward. But right now, it still seems healthy. So let's talk a little bit more about rotation and participation. Now, bull markets historically live off rotations. Now, rotations are when you have, one group or a sector that might have a strong move, then it takes a rest. And while it's taking a rest and correcting and pulling back, there's another group or a sector that starts to emerge and be the leader. And that's what keeps a bull market rolling along. There's constant rotation happening from sectors to extend the life of the bull. Now, participation is essential. We need to see a big swath of stocks participating in the uptrend. And a couple of things that we look at to determine participation is we're looking at the new highs and new lows, which we do every week. And we just looked at the percentage of NASDAQ stocks above their 50. We also look at stocks above their 200-day to make sure they're at healthy levels, and under the surface, we're not getting deterioration in the amount of participation. So the bull market, really, really needs participation, and healthy rotation is really positive because it helps with the volatility, so you don't get such sharp sell-offs. So let's take a look here. This is the S&P 500 looking with some breadth measures. Let's go from the bottom to the top, and the S&P's in the middle, but here's the new highs and new lows, the New York Stock Exchange. You can see we still have new highs continuing on the New York Stock Exchange. So this is still healthy, looking good. We're starting to get some really nice spikes where we're getting more new highs than we've seen in probably a year. So that's also healthy. The index itself is at new highs. We've had this nice post-election gap up that's continuing to move higher. And up on the upper panel here, this is the S&P stocks above their 50-day moving average. We're currently at about 59, and here's that 50 level marked on the chart. You can see when we get below 50 for an extended period of time, that's usually associated with corrections in the market. You can have little dips here and there below 50. You can see here we still kept going higher on these little dips, but we're above it right now. So it's healthy, but it's just something we want to monitor. Now, looking at some economically sensitive sectors, and I've drawn this chart going back to June. You can see here as the market started to correct, the financials, this purple line, were one of the first sectors in mid-August that started to get to new highs. So the financials got to new highs. And as we all know, in September, we got a rate cut. So with a little bit of anticipation there in the financials. You can see here that the new highs didn't come in the S&P 500 until early November. But coincidentally, at the same time, we got an acceleration in consumer discretionary. These are your Home Depots, your Teslas, your Amazons, all part of consumer discretionary spending. They launched to new highs, coincident with the S&P moving to new highs. Now, this golden color line at the bottom is retail. Retail's been in a long basing consolidation, but you can see here that retail is now hitting new highs, showing the strength of the economy and optimism going forward. Now, the green line is our home builders, very economically sensitive. Interest rates have been a little erratic in the last month or so. So home builders, they tried to make a surge and eclipse their old highs, but they backed off. So they're not at new highs yet. But again, economically sensitive sectors right now are gradually all participating to round out some of this bull market. Now, one of the specific areas of the market that is really becoming an emerging leadership is fintech. Now, what's interesting here is I've got a basket of fintech names, and they're all probably going to benefit because rates are gradually coming down. So that's going to help the lending situation. Also, these fintech companies are probably one of the first implementers of creating software applications at an enterprise level of using AI. So, we've seen chips and we've seen some of the energy infrastructure names do well. We could be moving into a phase of software applications that use effectively using AI. So these fintech names are nice small companies, many of them. They innovate, they can compete with better financial conditions. You can see the strongest ones have been Upstart, Firm, Dave, SoFi. And if you look closely, Square has had a breakout here just recently from a long bottoming base. Four and Toast have been acting really well, but got hit earlier this week on some comments made by Toast at a conference. But generally, fintech is looking very strong here. Keep our eye on those. If you're not in any of these, it might be something to keep on your watch list. I currently have a position in Square and Upstart. Okay, a bull party without chips just wouldn't be a party. All right, let's go back again, looking at this comparative ETF chart. going back to June, we in early July is when tech really peaked out. NVIDIA peaked out and the semiconductors peaked out and really started to have a long correction. And at the time, if we go back to previous GMUs, I talked about tech really had a broken leg. It was some serious damage done and it was going to take months to repair. And that's kind of what's happened. There's been a repairing process. In that repairing process, you can see basically most of August and September, the indexes were still below highs. Now, the first inclination that tech was really recovering was software and cybersecurity started to hit new highs in early October, and mark them on the line here. They're hitting new highs in early October. I also spoke at the IBD meetup in mid-October, and I gave my outlook for the rest of 2024 and into 2025. And part of that presentation talked about the really big picture, but part of it I said is we'll probably need tech to participate for a year-end rally, and we seem to be starting to get that. Okay, in early November, we got more indication. It's XLK, which is a basket of tech, and the NASDAQ composite started to hit new highs in early November. So you can see here now, since then, we've got software doing well, cybersecurity, the NASDAQ, XLK, and here we are with semiconductors, SMH. Okay, we're still way off the highs, but you can see the last 2 weeks, it looks like we're making a strong rally attempt. We're starting to see some of the semiconductor stocks act better. So I think it would be really encouraging to see the semiconductors start to participate and catch up. They were the leaders in 2023, and hopefully they're going to have another leg up maybe in 2025. So if we go a little deeper into this semiconductor theme, you can see that they're not all equal. You can see here that the leaders really are, if SMH is in the black line, you can see the leaders that are outperforming are Broadcom, Marvell, Taiwan Semi, and NVIDIA. Those seem to be the ones that are trying to lead this rally attempt. Other ones are just not performing. They're lagging. AMD, Micron, Qualcomm, Texas Instruments. So you probably still want to avoid those and look at some of the stronger names if the semiconductors are really going to have a year-end rally going into 2025. So keep your eye out as things emerge. Now here's the individual chart of NVIDIA. Now it was interesting, we've been watching this at Rain King, and we've actually tried a couple trades along the way. Interestingly enough, the old highs were back here from June where it topped out. And you can see we had a little breakout and we had a little shakeout here. And then we had another breakout with a little shakeout. And then finally, the stock tried to move to new highs and reversed. And it wasn't until we got this real sharp shakeout here in the last couple of weeks. The interesting thing about this shakeout here is we got an undercut of the previous two shakeout lows. So we've really shaken out. Anybody who still remained in the stock trying to survive these shakeouts probably was definitely forced to get out when things look pretty bad on the left side of this shakeout. But we did get a shakeout V, and you'll notice this blue line, which I typically will show looking at shakeouts. This is the 65-day EMA, which is a typical line that you get a break of the 50, the red line, and sometimes you'll get support right on the 65 exponential. And that's what happened here. And then we've seen a rally so far in a V-type shape. We like the Vs on shakeouts. So we want to keep our eye on NVIDIA because it really is the bellwether for the chips and some of the technology sector. I don't think NVIDIA is going to be doubling and tripling again. It really has done unbelievable move in the last year and a half, but it's important to keep your eye on this stock because it really is the bellwether for technology, similar to Cisco Systems was throughout the 90s with networking. For a good 5-year period, 95 through 2000, everybody was watching Cisco because it gave a great indication of what was going on in the industry. And there's no doubt that NVIDIA has that kind of force in the market with its chips. All right, so we've talked a little bit about some of the positive things going on in the market. I wanted to talk about sentiment because there are some cautionary signs. All right, here is the American Association of Individual Investors. This is the AAII Sentiment Survey. It's done every single week, and you can see the past few weeks. Just in the past week, we've had a really big shift between 37% bulls to 48% bulls. So the people that were at neutral or bearish have now jumped on the bullish party. And it's gotten pretty extreme. Historical levels for bulls is like 37.5, and the all-time 1-year high is almost 53%, which was about a year ago when things were going really, really well in the market. And then we had a correction in early January. So retail investors, when they start jumping in aggressively on the bullish side, they tend to be late and they tend to be driven by emotion. So it's going to be interesting if the market pulls back here, just as all the retail investors are getting kind of excited with the gains of the last 2 weeks. So we'll have to watch this. I mean, sentiment is really a tertiary indicator. I would not use it to trade off of, but I want to keep that in the back of my mind to know what the crowd is thinking. Now, I've pulled this chart, which I think is really interesting. This is the equity put-call ratio. And I've shown this before, but for those of you new to the video, this is looking at all the equities and puts and calls. When we get above 1, that means more puts are being bought than calls. And when we get below this red line, that means there's more calls being purchased than puts. And I use this at extremes. You know, when you get extreme put buying, when everybody's expecting the market to go down, you can see typically you might get a rally going in the other direction. Now, we've been moving up here the last 3-4 months, and you can see that we had a lot of low call readings. Actually, if you look closely, this is the lowest call reading, lowest level of fear in the market relative to puts and calls that we've had going all the way back to November of 2021. And those knowing your market history, November of 2021 is when the market peaked out before the 2022 bear market started. I'm not suggesting this means we're going into a bear market. All I'm suggesting is that we are at some extreme levels showing hardly any fear at all in the market. This means that everyone is bullish, everyone is buying calls. So usually when that happens and everybody gets on one side of the boat, usually the market will correct. So you can see here, the last time we had a pretty extreme reading in calls, or here, we had a market correction. I've marked this one. We had a lot of calls. We did had a very kind of sideways action. You can see the little correction we had in November. So the sentiment is getting extreme. Put call is a little bit extreme. I wouldn't be surprised to see a pullback coming, even though things do look fairly positive. We are seeing some rotations. All right, so let's try to put this all together, all these pieces of the puzzle. Now, definitely we're at all-time highs, the S&P and the NASDAQ and the Dow. So that's just completely positive. They're all above their 20-day moving average. So the power trend, the IBD power trend is intact, working well. New highs, new lows. New highs are continuing to build. So that's all, again, very, very bullish, very, very good. The leading stocks, simply said, the leaders are leading. But there is a lot of excitement building. People are getting pretty excited. So it's important that you remember to keep your feet on the ground here. Many times when you're trading well and you have your biggest gains, you can make your biggest mistakes because you get sloppy, you take on excessive risk, you start using leverage. So be careful about getting too giddy about your gains because if you make a few mistakes, the market will take it away from you. So keep your feet firmly on the ground. Exposure levels, I moved this up from 85 to 95 to 90 to 100%. They've been increased. Now, if you're in the leading stocks and you've got good cushion, you should simply be monitoring these stocks if you're a position trader. If anything, you want to find ways to add to a leader to get more money into that leading stock if you find an appropriate buy point to make a proper add without increasing your average cost too high. I really would advise avoid the laggard stocks, particularly the laggards within a sector that is already performing. You really, really want to focus on the true market leaders. They're the ones that are going to correct the least and they're going to go up the most. And once you're in those leaders comfortably, Give them time to breathe. Again, I mentioned you should be at the monitoring stage here, and it's the sitting, as Jesse Livermore says, it's the sitting that makes you the big money, not in and out of stocks on a daily basis. So let's keep our feet on the ground. Let's try to keep ourselves calm, even though our leading stocks are doing real well. We still want to be diligent. Now, the quote of the week is from Peter Thiel, the entrepreneur and venture capitalist. He says, "The most contrarian thing of all is not to oppose the crowd, but to think for yourself." So take heed of those words of wisdom from Peter Thiel. The market's going well right now, but we also want to be prepared in case we get into a correction. Now, a couple of key announcements. If you go to Rain King Insights, which is at rainkinginsights.com, on the homepage, you're going to see here, we're going to be releasing our latest model book, which is the 2020-2021, the COVID bull market model book. We're going to have a research report over 250 pages with a 3-webinar series. So watch this video. It's a 15-minute video going over all the details of what's in it and how you can sign up and participate in getting this model book. So I encourage you to watch that short video. Also, you can get more information about the model book at Blue Sky. Just last month, me and Mike Kincaid did about an hour presentation on a couple of excerpts of some of the insights from the model book. That's about an hour presentation, but if you want to get more depth into what this is all about, you might want to watch this free presentation. Also, about 2 weeks ago, I did my latest podcast, and it was all about debunking the myths of the stock market. And so we get into that for an hour podcast, again, free on the website. So take a look at that. Now, another exciting announcement is earnings reaction gaps. JT from tickermonkey.com and myself have partnered up with Benzinga. Benzinga is the news aggregator, stock market aggregator, and news feed. We've teamed up to offer our earnings reaction gaps course. So we're going to be giving a free presentation, 1-hour presentation on Sunday, December 15th at noon Eastern, 9 on the West Coast. We encourage everybody to sign up for that and get a little bit more information about what this is all about. JT and I are very excited about this opportunity to share some of our knowledge and how you can actually participate in getting involved with earnings gaps. The link to register for this is on the X post. So go to my X feed and you can just click on the link and it will bring you to the Benzinga page where you can sign up for the free webinar. So please take advantage of that. And the last component is I wanted to invite those of you that were not Rain King members to join our site at rainkinginsights.com. Get a membership. We are actually preparing for tomorrow. All members of Rain King Insights, we're doing a huddle session. We're going to be doing a session on trader assessment. We're looking at all the qualities of traders when people will do their own assessment to find out where their weaknesses are, where their strengths are. And then we're going to spend the huddle going over important ways that we can find ways to improve our weaknesses and compensate for those and magnify our strengths. So if you become a Rain King member in the next 24 hours, you actually can get involved and get in on this webinar for members. So I invite you to that as well. Go to rainkinginsights.com. All right, that's a lot for today. That's the general market update for December 6th, 2024. Thanks to everybody. I hope you all have a bang up weekend. We'll see you all next week.